Good morning and good afternoon, ladies and gentlemen. Welcome to our 36th gathering that was formerly the COVID webinar and is now the Housing Market Update. Ali Wolf and I are thrilled to have you with us today. And we want to make sure you know we'll send the recording out afterwards, and we are happy to address any of your questions. I'm sure you've heard me say before. We listen to your questions and we use them as a guidepost for things that we'll think about for our next gathering. And we are beholden to what you want to hear about. So please do share with us your thought processes. And I'd also like to acknowledge that we have a wonderful sponsor today, and that's thinkwood.com. And ThinkWood reimagines the possibilities of wood by providing single-family design and build resources to contractors. And their environmental and biophilic and health benefits can offer market differentiators. And that is so important in today's market. You're going to hear Ali and I talk about a whole bunch of things. Finding your differentiator is so key. And what ThinkWood can do, it ultimately boosts a project's value. So discover the project profiles and the design tools, get some free project support. Check out thinkwood.com. That's an easy one, thinkwood.com. And again, thank you for the team there. Ali and I are part of the advisory team within the greater Zonda team, and the world is shifting, and so is the work that we're doing. This gives you a flavor of some of the things we can help you with. Right now, of course, that single family rental side of the world is very, very busy. My associate and dear friend on the multifamily side, Kimberly Byram's busy on the multifamily side. And of course, we're doing deep dives into consumer attitudes right now, led by Molly Carmichael. So take our closing survey, please, to get more information, and I'll show you that at the very end. And what's been so cool is we've done this merger with Metro Study and Myers to create Zonda, is that our platform now has been ultimately curated for our different client setups. We've got the home builder side, we've got enterprise, which covers everything, mortgage pro. Please reach out to your director of business development in your area, or just get on zondahome.com and we'll help you out with that. And we're expanding our offerings, and we're trying to get smarter and smarter in the market. We brought on over this last year Livable, which is the largest online for new home listing destinations. And the key thing here is it's free. It's free to list. There's free leads. Karen Bonder at kbonder at zondahome.com knows everything about this. But also check into our Zonda Virtual, because it's such a cool way to look at the interior of a home virtually, and it's really customizable, and that's the coolest thing about it. But please reach out to Karen. She knows all about it, and she'll be able to get you an example. Last year, or I shouldn't say even last year, it's still this year, 2022, we had a huge number of incredibly successful events. This gives you just a flavor of looking forward what we've got coming up. The Deal Makers events have turned into a great place for you to meet and greet new opportunities, whether it's capital, home builders, anyone on the mortgage side. And then, of course, we've got our build to rent gig coming up in Dallas. Please check in on that. Look at zondahome.com for our events. There's some really great stuff coming up. And as we get our agenda together, I want to warn you that both Ali and I have been fighting whatever's going around. It's this time not COVID, it's cold stuff, it's the chest stuff. So if you hear us sneeze or cough, please forgive us, but know we're safe because we're locked on our own offices. And here is the introduction to get Ali set up. I think you know she's our chief economist, but she's also supported by the entire advisory team and two incredibly smart economic analysts, Nick Schoolis and John Misneros. But what I want you to know is how Ali's been spending her time using our information and getting out into the market. She's daily making presentations and interactions with building product groups, and Todd Tomilak knows a great deal about this. He leads our BPM team. Home builders and the board of directors with home builders. So the feedback we get from them is sometimes different than the feedback we get on the field. And then capital providers. And all of this comes together because Ali loves to learn. And I wanted to let you know that she's done two things over this last year that you might initially think are crazy, dangerous, adventurous. But she took a trip to Africa about a year ago with her mom and did some incredible adventuring, and actually just got back from South Korea a couple weeks ago. And Ali is an adventurer and a traveler, and this translates directly into what she's like as our chief economist. She's always uncovering new things and finding new ways to look at things. And here's my setup for today. There's some information that isn't comfortable. There's some information that's not great news. We're going to share it. It is what it is. We're going to look for the silver linings and the opportunities, but just know that as painful as it is to see this, we will get through this at some point too. And with this, ladies and gentlemen, allow me to bring to the virtual stage Allie Wolf. Allie, take it away.
Awesome. Thank you, Tim. And I think that setup was so important because as we go through the data, like you said, we're going to point out some uncomfortable truths. And then we're also going to say, well, what can we do about it? Or how might that change in 6 to 12 months? And you'll hear us mention that a few times throughout today's presentation. Now, I really have 3 distinct sections that I'm going to go through in today's presentation. I'm going to start with the economy. And from there, I'm going to move over to what's happening with affordability. And I'll finish the discussion with supply. Now, hopefully, okay, good. I know there's one little block in the bottom right. Sorry about that. We're going to get that fixed, but that's going to be there for the entire presentation. So we tried to adjust the content to not show that. But let's start here with the economy. And I want to start with what seems like a broken record, because of course we need to start again with inflation. It is still the top metric to watch. And I guess the good news on the inflation side is if you've looked at some of the data over the past couple of weeks, we have had a couple good, or I guess surprisingly good reports. And it's funny to say the word good when we're still looking at inflation that's up between 6 and 8% compared to last year. But these reports are, at least from some experts and I guess I would say analysts' point of view, proof that maybe we're past the point of peak inflation. And as we saw those reports come in, many of you probably saw how financial markets responded. The S&P 500 now is up 8% just over the past month, obviously after falling pretty dramatically. And the 10-year Treasury has gone from 4.15 to 3.7 in 1 week's time. And we know what it means when the 10-year Treasury yield goes down, also means that rates have come down a little bit as well. We'll talk more about that as we go through this presentation. So inflation's still high, again, should be averaging 2, but some signs that maybe it's rolling over. Financial markets getting a little bit excited about that news, and the Federal Reserve saying, chill out. While we do have the inflation numbers that look a little bit better, the Federal Reserve governors don't want our financial markets to just fully rebound that quickly, because from their point of view, from the Fed's point of view, we still have a long ways to go until we're at a point that the economy is back under control and back to something that's more healthy. Because what the Federal Reserve will do is, of course, they're going to look at those top line numbers, but they also dig into the data and cut it in a lot of different ways. And one way you can look at this is looking at the major groups of inflation and seeing how high those levels go. Again, remember, we won about 2%. Right now, 10% of all of the major groups have inflation under 2%, meaning 90% still have inflation above the Federal Reserve's target. And you can look at this by category: transportation, food and beverage, housing. These are the top 3 categories that have the highest change in that overall inflation number. And what do those have in common? You can't live without the transportation, without food and beverage, without housing. This is not discretionary. This is basic living expenses that are still very high. Let's take a look at housing. Still up 8% compared to last year. And when you dig into this data, going over the past 25 years, housing's relative share of importance in inflation has been between 40 and 43%. Shelter is a massive component of inflation, which is why it's so important to see this sector cool a bit to, in theory, help bring down the overall inflation number, and to have the Federal Reserve say, okay, we feel like we've done enough. We feel like we've seen enough of a widespread pulling down. When you look at this, the 2 main components, one is owner's equivalent rent. Remember, the way you think about that is if you own a home, how much do you think you could rent your home for? The second highest category is rent in general. And finally, we're seeing a little bit of softening on the rental side, which again is important because if we continue to see rent growth growing, the Federal Reserve is just going to push harder. So we need to see some of the market responding. As we look at the effective rent change, we've had a couple months now where on a month-over-month basis, rent change in most markets across the country now has gone negative. Still up year over year, but finally starting to roll over. And again, that's important. If we're trying to say we need the Federal Reserve to stop, they're not going to until we can see this overall level come down. What's important to know historically is that the shelter component in inflation usually lags changes in the for sale housing market by about a year. So what this is telling us is probably going into the first and maybe even second quarter of next year, we may still be reevaluating these numbers and rechecking to see if we're seeing enough of a cooling effect. But overall, when you look at it and you want to apply it to the for sale market, we had that data. Inflation cools more than expected in October. Again, still high, but at least cooling a little bit more than the anticipated rate, usually looking at the month over month, but also tracking those year over year. And the resulting impact is that we've seen that downward pressure on the 10-year Treasury. We now have mortgage rates that were averaging over 7% that are now averaging in 6% territory. Now, high sixes. And I want to acknowledge how we should look at that, or at least the way that I'm looking at it. I've had some clients say, hey, rates have gone down so dramatically, so quickly. This is going to be really good for the market, isn't it? Well, I think in one way, I guess it depends if you're looking glass half full or glass half empty. Because where we were when you combined home price appreciation with rising rates, as we were at a point that monthly payment nationally was up 80% since the beginning of the year. That was 7%. When you go from 7% to 6%, which is not where we are, but we're in the mid sixes, but let's just say we drop down that full percentage point, that gets you to a 60% increase since the beginning of the year. If we get down to 5, that brings you to a 45% increase since the beginning of the year. So yes, I do think it helps with maybe not having to do as large of incentives, or maybe some people that were sitting on the sidelines react to it. But ultimately, when you're looking at the fundamental problem, it's saying that affordability is still going to be an issue with 6% rates. Again, just not as dramatic as what we saw with 7. But what's interesting about all of this is you may be saying, well, it's weird to hear that rates have gone down when the Federal Reserve is resolute. They're going to continue to raise short-term interest rates. They're saying it, probably not another 75 basis points, probably more 50 or 25, but they're continuing to say that. And it's because, as we know, there are a lot of factors that drive rates. It's not just the Federal Reserve. It's inflation, which is why we keep talking about this month after month. It's expectations of what might happen to the economy. It's the number of active investors, which has changed because of quantitative tightening, which is what we talked a lot about last time we met. And it's looking at how investors are viewing alternative investment opportunities. So anytime that you've joined our webinars, we've talked about the 10-year, and that's because we know that investors will be looking to place their money in fixed income. And when they go to that space, they're going to say, well, where do I want to place the money? And a common comparison is, well, what are we seeing from the government bonds and what are we seeing in the mortgage-backed security market? The MBS market is what directly drives mortgage rates. Now, we just put a blog out on Builder Online, I think it was yesterday, about this. If you haven't read it, you can see the link down there to copy it, or you can just go to Builder Online and you'll see it. But we were trying to understand what is happening with the mortgage-backed security market, how that's playing into mortgage rates, and what's happening with the 10-year Treasury. In the high level, what you need to know, I guess the takeaway of the article is there's a lot of dysfunction that is happening in the mortgage-backed security market right now. When there's dysfunction, that messes up the relationship between the mortgage market and the Treasury market. And so there's normally a spread that you would see between mortgage rates and Treasuries. If you look at the historical average, we're talking about 1.7. That's telling you that normally mortgage rates are about 1.7% more than the 10-year Treasury you would see on the front page of the Wall Street Journal. During times of economic uncertainty, today, the beginning of the pandemic, the great financial crisis, the 70s and 80s with the level of inflation, you see that spread widens. So where we are today is our spread is about 3. So meaning mortgage rates are about 3% higher than the Treasury yield versus a historical spread of 1.7. Over time, that does compress. When you get back to more healthy parts of the market, you will see that come down. And if our spread were to normalize, which I believe over time it will, that means that we'd be looking at rates today that are in the mid 5s versus those high 6s to 7s that we're in. And this goes back to Tim's introduction, looking at the here and now, which is rates are up and I think they'll still be volatile, but also trying to plan out how that might change as we look over the next 12, 24 months. There's another factor as well. And this is one where it's part good news and part bad news, which is when you look at recessions, and many of you know our expectation is that we do fall into a recession, and a recession to us means seeing job losses. We do expect to see that national job losses, not just individual company job losses. We do expect to see that next year. We absolutely could be wrong, but as we're putting together our forecast, that is what we're assuming. And when you do see a recession going back to the 1990s, you see that the 30-year fixed rate mortgage comes down 100 basis points after 18 months of the official start of a recession. Meaning once you go into recession, it takes a little bit of time, but you do ultimately see mortgage rates coming down historically on average 1 full percentage point. So there's a couple good factors here that, again, recession, not good, but what it means for rates is they probably come down. Spread right now, a little bit erratic over time, that should come down. I think those are a couple silver linings that I see in trying to forecast forward. But I also want to acknowledge we do not think the volatility in rates is over. I think one bad inflation report, one jobs data that surprises to the positive, you'll see that 10-year go back in fluctuation. We could see rates back in the sevens. We could see rates higher than the sevens. But when we're looking at trying to forecast forward, that's something we're considering. But let's go into this. So if we think, okay, maybe rates come down, rates are coming down related to maybe over time. Again, this is not what we're calling for in the next 6 months, but related to some kind of harder economic times. You then want to think about another component. Now, Tim and I do events with Bank of America on a regular basis. And there was something that their analyst said last time that really stuck with me, which was we're seeing some of this disruption in the housing market at a time that the labor market is so incredibly strong. What happens when there are job losses? And I think that's an important consideration is, okay, yeah, maybe we can be enthusiastic that top line affordability could get a little bit better related to rates over time, but we may also be in an environment where there are fewer people working. So how do we look at this? We went back to the past recessions going to the 1970s. When you go up and down, so on the y-axis, that's telling you how big is the drop in jobs. And when you go left and right on the x-axis, that's telling you how long do those jobs stay down. We don't think we're going to see another kind of job losses like we saw during the pandemic. That's that really sharp down. We don't think it's as stretched out as what we saw during the great financial crisis. But when you remove those outliers, we still think that we could see job figures that are down 6, 12, in some cases, 24 months. So we're considering what happens to the labor market. I think a more easy way to understand it is if you look at the recessions going back since 1990, the unemployment rate typically rises 1.6 percentage points 6 months after the official start of a recession and 2 percentage points after 18 months. So when you put those things together with, okay, maybe, again, we could be wrong and maybe there aren't job losses. This is our base case is that we see this. You see the unemployment rate go up. But know how the Federal Reserve perceives this. The Federal Reserve says we'd rather see the unemployment rate go up. They've said that they could tolerate an unemployment rate that's in the 5s versus in the 3s because getting inflation under control is issue number one. Not getting that under control is more disastrous than seeing the unemployment rate rise from something from 3 to maybe 5%. Now, as we're looking at all of this, the basis of that discussion is that there are some risks that we're seeing now. There's some potential good news as we go a little bit down the path, but a big part of it is that affordability is still an issue, whether we're talking a 5% interest rate, a 6% interest rate, a 7% interest rate. And we know on the ground that buyers are responding to these higher rates. When you look at existing home sales, remember, from a national basis makes up the majority of overall activity. We see that actually existing home sales are now at the lowest level they've been since the end of 2012. And when you look at that, it's not just inventory based, because actually in 2020 and 2021, we had lower levels of inventory, but a higher number of overall transactions. When you're looking at the existing home sales, it's a combination of both the supply picture and buyers responding to what's happening with affordability and overall confidence. But we also look at this from the new home side. And it's actually very fun because today is the first day we're ever releasing our new home sales number. That's a total absolute number tracked in our Zonda database. Nick Skoulas, John Mazzaros on the economics team were instrumental in getting this done. And what we did is went through our database, where many of you know the most comprehensive new home database covering 65% of total new home transactions. We're able to account for cancellations. So we're able to say, this is how many homes have sold. And we're also accounting for, in today's market, Tim will talk about later, there is a pretty high cancellation rate depending on the market that you're in. So when we look at total absolute sales, our number shows that we're back to the lowest level we've been since 2016. But again, this is a combination of supply and demand, which is why some of you know and love our new home pending sales index. What I like about this is we combined total transactions with the average sales rate per month per community. From our point of view, this is a way to get a sense of the market looking at both supply and demand. And when you layer those two factors together, it's telling us that the new home market nationally is operating right around 2018, in some cases 2019 levels on the high level basis. So national, that's what we're looking at. Let's say 2018 is where we are right now. Then you can break that data up by market. So I'm going to show you two different slides that look very similar, but they're going to look at different data sets. I want to give you a lot of context before I show you the markets. This slide is looking at total new home sales. That means how many homes have sold, 1, 2, 3, 4, literally a count of those numbers. When you have community count down like we do today, and I'll show that later, this number will be down again, partly because there's just not as many homes to sell. When you look at this number, though, again, it's a demand story and supply. We're going to look at the last 3 months just to remove any kind of 1 month volatility. And our Zonda database that tracks contract sales goes back to 2015, really good scale starting in 2016. We can also do this data for closings. I just didn't want to do it for closings right now because when the market's moving so rapidly, I think contract sales just make more sense. So as we look at this, you're going to see some of the areas where it's just hard to get more homes built. The overall inventory just doesn't fluctuate that much. There's not that much developable land. These markets are holding a little bit more steady in terms of total volume: Miami, LA, Boston. You can go down the list. 2018, again, some of the areas where it's harder to get homes built, a little bit more stable markets in the Midwest and in Houston. You can look at 2017, Minneapolis, Cincinnati, Chicago, Baltimore, Austin. Then you have that big cluster of new homes markets where the total contract sales are back to 2016 levels or maybe even earlier. Again, we don't have all of the data to say, hey, this market's back to 2012, at least in terms of contract sales. So here what you're seeing is a large cluster towards sales have really gone down, again, for both of the reasons that we've talked about. But let's take this data and also look at the average sales rate. I love average sales rate. I just like it that it adjusts for overall inventory. It's just saying if a builder is willing to sell homes, how well are they selling? Again, based on the last 3 months, you're going to see a lot more variety of where the markets end up coming here. 2019, you're seeing lots of clusters in the Northeast, in the Southeast, and in the Midwest. When you go to 2018, you're seeing some of the similar footprint with Jacksonville and Nashville, Salt Lake City, LA, Sacramento. Going back to 2017 and 2016, you're seeing some of the markets that we've used the phrase weak to describe, places like Denver, Las Vegas, Phoenix, Riverside, Austin. But this highlights what we talked about last time that we met, which is there are still absolutely clear differences by region, where the eastern part of the US continues to outperform the western part of the US. And some of you may have seen, we posted this on LinkedIn, but to me, this was such a big aha moment. And Tim, I will apologize. I know for people that are colorblind or struggle with colors, I know these colors were actually a very poor choice. So I apologize for that. Basically, just know if it's a darker color, that's telling you that affordability is getting more stretched. If it's a lighter color, not as stretched. What we wanted to do is look at the payment to income ratio in 2010 and compare that to 2021, which is the most recent full year that we have. If you look back in 2010, the payment to income ratio was the highest along the coasts, which makes sense for regulation reasons, for barriers to additional buildings, larger populations, et cetera. You can see that for the rest of the country, the payment to income ratio is at least reasonably in line. Then you look at where we are today. This to me was the chart that really stood out. As you can see, those markets in the Western US, Mountain West, West Coast, Southwest, the three regions that I would say have become and are the slowest across the country, are also the ones that are now finding that that payment to income ratio has gotten so out of whack. In a lot of the top markets, you have seen job growth, you have seen migration, you have seen high level of home prices, but it's when you're layering in the incomes, which of course varies, local income versus relocation income. But we're seeing how with the higher home prices, the higher interest rates, those are some of the markets where buyers are now really getting pushed to their limits. But let's look at this a little bit more, because when I look at that, I say, okay, well, what then do income support? If our payment to income ratio is so out of whack, what kind of payment would make sense? And what home price does that translate to? Up in the top right, some of you may recognize this. This is a snip from our favorite data, the domestic net migration that comes out once a year. It's not new data yet, but I wanted to start with the areas that have had so much migration: Austin, Jacksonville, Raleigh, Phoenix, Tampa. You can go down the line. I wanted to say, well, what happened in 2019 with the affordability levels when interest rates were lower? Let's assume 30% of the income goes towards housing. What did income support in terms of home prices in those markets before the pandemic? Now, as you look at this, know that we do not include property tax and insurance. So in some markets that have higher property taxes, I'm thinking Texas in particular, the numbers may look a little bit out of line just because of that factor. But if we look at this, we're saying, okay, in some markets between 400 and 500, we could see that that is what income supported. And back in 2019, when you layer in where those home prices were, the markets were reasonably in line. We were talking about affordability. We were saying, hey, be careful to not stretch affordability too much, but you could see what the income support and what the home prices were reasonable. Now let's look at where that data goes today. And before we do, I just want to acknowledge this is income, not wealth. And so that's another objection you could have to this data. Well, income doesn't account for inheritance or cashing out on stocks or home equity. Yes, of course. But we're trying to do income just as an apples to apples comparison to be able to track this over time. We know that there's been home price growth. We know that there's been income growth since where we were in 2019. Let's see how that's changed. Interest rates now at 6.75%, still assuming 30% of income towards housing. I kept the y-axis at 600,000. So notice it goes up to 600 here. I kept that here just so we can compare how that looks. These are now the same markets that over the past couple of years have seen so much home price growth. Yes, income growth, but man, those numbers are really out of line today. It's showing a very different story than what it did just going back to 2019. Okay, 30% of income towards housing. Maybe I'm being too conservative. Let's go to 35%. You can still find that each of these markets are out of line. When we look at this, I know that not all of you are in these migration markets, so let's go a little bit more. I'll show a few more markets here. Maybe yours still isn't shown, but we wanted to show just a little bit more across the board. So here as we're looking at it, 30% of income towards housing, here 35%. To me, I think there's a few takeaways that I have here. So look over to the middle of both of those charts and you see some markets that actually are fairly close in line. Let's ignore some of the Texas markets again for the property tax reason, but look at places like Columbus, Charlotte, Indianapolis. These are markets where the income supported home price and what the home price is are actually reasonable-ish in line compared to some of the other markets. If you look at the performance of Columbus or Charlotte or Indianapolis compared to somewhere like Denver, for example, we do know that those markets are operating on very different levels. Denver has slowed a lot more than the markets where consumers are getting stretched, but maybe not stretched to the max. Now, to me, as we go through these markets, this highlights the risk of these markets of how do we ultimately make this work? Because even if rates go down to 5%, you're still going to be struggling with a pretty big mismatch. But it also highlights the opportunity. We're in the new home community. We're not subject to, existing homeowners don't have the ability to fully change the product the way that we can, whether we're changing sizes or finishes or location or land prices. How do we get that to ultimately make sense? How do we get the material prices to come down, which I think there's some hope that does ultimately come down as we look into the next 12 months, but governmental regulations and fees, how do we get those down? I think there's a lot of levers that we can pull. It's not easy, If it was easy, everyone could do it, but I also think you can glean a lot from how much these numbers have ultimately gotten out of line. Now, as we look at this, the way that those numbers got out of line was partly because of everything that happened with the pandemic, the low rates, and the fact that resale inventory basically left the market. When you look at active listings, we're continuing to see a little bit of growth in active listings, where now on the resale side, we're above 2020 and above 2021 levels of active listings, but barely. We're still down a little more than 35% compared to where we were before the pandemic. Now, that's the national story. Remember from last time we met, depends on where you are. Phoenix, Austin, Salt Lake City, Vegas, you do have active listings above where they were in 2019. The majority of other markets, though, remain below, and in a lot of cases, considerably below, which makes sense. I think we all can understand the lock-in effect. We can all understand the economic uncertainty. We can all understand people saying, well, why would I sell and move right now? Why do I want to reset my interest rate or buy a more expensive home that's maybe not as big or not as nice? When you're looking at this, for a lot of primary buyers, they're choosing to sit still. There's a freeze up from the existing home market listing new properties, with the exception of some motivated sellers. Last time we met, I think we talked about the flippers and how some markets were at a record high number of flippers. We do know there's investors that are in the market, and we know that the iBuyers have pulled back on sales, but in some cases, they're still holding some of the homes that they need to offload. When we look at the iBuyers, we're looking at who would be the motivated sellers, where is there a large concentration of those, and what do those sellers ultimately do to the market? These numbers have gone down in terms of the sales of volume, but if you collectively look at them, there are some markets where there's a reasonable part that is owned by iBuyers. So again, Phoenix, Tucson, Atlanta, Charlotte, Jacksonville, Vegas, Durham, Lakeland, Raleigh. We're tracking some of these markets with having the higher share of those iBuyers and taking into consideration what people like Glenn Kelman, the CEO of Redfin, is saying. They're saying that we immediately started marking homes down, and we will do so if we need to. We need to move the product. It's not just Redfin, who obviously closed their business recently, but it's any of the other iBuyers or flippers or investors that need to sell now. They're going to be more willing to adjust the price down, and they're going to be more willing to or able to impact the overall market trends as well. Not a huge share of the market, which is why we do see those overall inventory levels so low, but I think worth considering, especially as you look at it by market. But we can see that the overall resale inventory is down, but there are motivated sellers. I would say the exact same thing in the new home side. When you look at new home community count, we're down 26% compared to where we were last year. Sorry, compared to 2019. So down 26% compared to 2019 for community count, but there are still motivated sellers in today's market, and that's related to quick move-ins. We've talked about quick move-ins in the past, just as a reminder, homes that can be moved into within 90 days, also known as standing inventory, speculative inventory, QMIs. You may hear different ways to say this kind of inventory, not always standing. Again, it could be something that is still under construction right now. When we look at the quick move-in data, this has changed really dramatically. Remember, builders, for the most part, had intentionally shifted to do more spec building because it made sense when the market was just going. Now, some of those homes that were built as spec are coming to the market at the same time that demand has shifted down. So when we're looking at the weekly quick move-ins, just actually a few weeks ago when I was presenting this data, I was saying that weekly quick move-ins were up 10% compared to 2019. Now, when we look nationally, we're up 44% compared to where we were in 2019. And again, it depends by market. We have the current, the last year, the 2019 levels here, and some year-over-year changes. Now, an objection that I've received from presenting this is, okay, that's great, but what does that look like in terms of months of supply? And easy, we can do that. And that's what I want to show you next. When we look at each of these markets, this is looking at the year-to-date quick move-in of 2019 versus today, looking at that change, and then importantly, looking at the historical months of supply. So 2015 to 2021, what were they averaging? And then what are we looking at today? You're going to find, again, it varies by market. In Phoenix, the historic average was 0.5 months of supply. It's at 2.8. To me, that's saying that market has gotten out of line in terms of the overall QMIs, where total volume is up, but also the QMI is up. The months of supply is up. Go down to LA. This is a market where historically 0.3, now 0.5. Again, we talked about just some of the barriers to get homes built, usually acts as a bad thing for the market, but in a time where the market has shifted, it actually is a little bit favorable to not have too much standing inventory. But as I went through this data, I went through each of the markets and made a note. Are these markets normal? Are they low compared to history? Are they high compared to history? So I'm going to show them here. And then when I pass it off to Tim, he's going to take the exact same markets that I highlight, and he's going to show it for total units under construction. So we know that QMI is just one part of this big supply puzzle. But as we look at this, let's start with the first markets that I classify as their level of months of supply of quick move-in is just back to what we would say is more normal. Atlanta, Charlotte, Indianapolis, Orlando, Philadelphia, Nashville. You can track the history of these markets. You can see that QMIs went down. Makes total sense that they would be very low, in many cases, virtually non-existent, and that they've been going back up. Take a look at the y-axis. We're maxing out at 1.2 here. That's going to be a big difference from the slide I'm going to show you in a second. When you're looking at these markets, this QMI feels reasonable. Generally speaking, we say 1 month is equilibrium. Absolutely depends on the market that you're in. But ultimately, as we're looking at this, as long as the rate of change does not continue at the pace it does, and these numbers don't get too much higher, these markets, from my mind, we are seeing incentives. We are seeing some price drops. We're seeing builders that are motivated and want to sell the product, but not to the same extent as what we're seeing in some other markets. So here, I'm going to show the markets that now look high relative to their history. As you look at this, Jacksonville, Phoenix, Riverside, Austin, Denver, Sacramento, we're looking at the QMI adjusted for months of supply, looking at history. Look here now at the y-axis. We probably could have stopped it at 3, but you're looking at a very different chart compared to the one on the left, where some markets are operating with those higher levels of QMI, which again, in our mind, means more willingness to either drop price, move product, add additional incentives to at least get those homes off the books. Now that's the immediate term. And as I turn it over to Tim, he's going to talk about starts and under construction, and we're going to take it a lot further. But as you can see, there's a lot of puzzles that we're trying to puzzle pieces that we're trying to put together to make sense of the markets and how they're evolving. So with that, I would like to reintroduce Tim Sullivan, Zonda's Senior Managing Principal of Advisory. Tim oversees our entire custom market study business, including our land and lot analysis. I'm sure many of you know we have proprietary data that no one else has on what's happening on the land and lot slide. We also are doing built to rent research and repositioning studies. Tim and I were at Zonda's Future Place event last month, and it was a no-brainer to me what his introduction was going to be after that day. Tim was the MC of our event, and his unexpected comments and actions kept the audience engaged the whole time. Tim, I will say there were 2 letters in particular that caught people's attention. Towards the end of the event, there was a guy that was sitting next to me, and he was new to Zonda. He had never met or heard of Tim or myself before. And at the end of the day, he said, "You guys really seem like you have a lot of fun." And we do, largely thanks to Tim. So Tim, I'm passing it to you.
Well, that is very, very kind of you. I think I need to change my title to Chief Fun Officer in spite of the data that we're going through. And Allie, I'd like to go through a couple things, a few observations, then a clarification, then a question that actually comes from the audience. I want to restate a couple things, make sure everybody caught it. On inflation, Allie's quote was, "We still have a long ways to go. This thing is not leveling off anytime soon." Secondly, note that she was talking about the affordability challenge was that double punch of home price appreciation and rising mortgage rates. Well, that's being adjusted right now. That lever of home price appreciation in many markets is home price depreciation right now. And the mortgage rate numbers, well, that's what I want clarification on. And Allie, come back to us because you said 2 things about interest rates that give me hope for the future, not short term, but down over the next 6 months, year, 18 months. And it was about the spread that we typically see, and also what happens after a recession. Would you restate both of those factors?
Yes, so let's just say high level. The spread historically is that mortgage rates are 1.7 above the 10-year treasury. Right now it's 3. So if that came down, we'd be looking at rates, if everything else held the same right now, you'd be looking at rates in the mid 5s. So that's 1.7 to 3, getting those numbers back in line. The second is about 18 months following a recession, mortgage rates historically have gone down 1 full percentage point. So that's another number to consider.
Right on. And that's, ladies and gentlemen listening in, we're not saying that this is very good news, but we've got historical perspective to know there's rationale to expect rates will get compressed over time. So that's really the takeaway here. And then, Ali, we had an interesting question from the audience, really about costs. And based on the conversations you've had with ultimately the construction people and home builders, do you see costs coming down with this compression of construction? We're building fewer, homes, so therefore, will we see the cost basis in labor and construction move down?
So what I have heard so far is on the labor side, with fewer starts being built, there are some of the construction crews that are not pushing their prices as much, or maybe more willing to negotiate than they were in the past. So I think maybe a little bit of a softening on the labor front. No, anything I say today does not mean it's necessarily in fact tomorrow or next week or next month. This will take time. We're all going through this rebalancing of the market in real time, and things just don't shift, except demand. Things don't usually shift on a dime that quick. On the supply side, I'll share from my own conversations is that it seems like, yes, there should be some increased production capacity at the same time that there's not as much demand for those products. Todd Tamilak, our building product experts, reiterates that from the research that he's doing on the ground, is he does think that there will be some compression in terms of building material input prices as we go over the next 12 to 24 months.
That makes sense. And last thing, you showed us QMI. In just a few slides, I'll show units under construction. Is QMI a part of units under construction, or is it additive to units under construction?
So it's a complicated answer because they're two different data sets. So I would look at them as separates. One comes from our legacy Metro study data that's released on a quarterly basis. Our QMI comes from our legacy Myers research data that's updated really on a daily basis, but we're updating it internally weekly. So just a bit different.
Stay with us, Ali, and we'll get moving. Fasten your seatbelts, ladies and gentlemen. I'm going to go through the under construction elements, a little bit about real-time housing, some affordability elements, a touch on BTR, and final thoughts. Key thing to look at this. This is the third quarter 22 top markets by housing starts. What we want you to note is really the factor that we've got starts that have been pulling back for the last number of months. Now, notice that when you look at annual changes, some of the markets are down because of this movement. But we're looking at a couple different data sets, like Ali just said. But note that builders started making adjustments a number of months ago. That's good news. The question is, how much will we adapt? And also look at that fourth bullet point. Most builders will say, we have got to sell those spec homes first. So monitor this, but the direction is encouraging for us, the way that we're moving. And as we're asking the questions, we interview over 300 building companies every month. And we ask that question, do you anticipate slowing down housing starts? I mean, this ties beautifully to what I just showed you. Look at the yes significantly number and the yes slightly number. When you put those together, it's about 81% of the builders are anticipating that they will be pulling back either slightly or significantly. The other 19%, well, they're talking about it, I can guarantee you. And then as they talk about the housing starts next year, now keep in mind the left side is this year, next year, it's an even bigger number. I mean, almost 90% are saying, yeah, we probably will. And remember, it has to do with QMI. It has to do with the specs that were built in anticipation of a market that was exploding that suddenly stopped. And that's what we've got to burn through and build through first. Now, we typically are seeing some shifts in that supply chain and therefore the delivery timeframes for homes. But given our most recent questions, notice what builders are saying, how much time they need for a completion, taking a home from start to construction, a completion. 8 to 10 months is about 40% of them. By the way, if we'd asked this 8 months ago to a year ago, most would have been on the far right side, 15 months or more. And when we look at the total number of housing units under construction, and this is based on US Census Bureau numbers, notice that that upward trend is just like what Ali was showing you. but also look at the last couple of months, we're seeing a leveling off. Now, when we look at units under construction by metro, it tells a little bit more of an alarming story, because you can see some of these markets have doubled. And you know, look at Sarasota going from 2,600 to 8,000 units. But look at the bottom five: New York, LA, Seattle, San Francisco, San Jose. Ali pointed those out, and these are markets where we've got constrained supply of land. We've got, you know, a huge amount of environmental challenges to build. So there are still markets out there that just didn't get oversupplied, because they never will be oversupplied. But the market is shifting. However, we are moving a battleship. It is moving slowly. Now, this factor gives units under construction by metro area. And as Ali said, we wanted to show months of supply and compare these markets. So as you read from top to bottom, you know, LA, Denver, Austin, and note that we're looking at the first 3 quarters of 2019 versus the first 3 quarters of 2022. We'll show you the percentage change, and then give you kind of a benchmark for the months of supply as of now versus what was typical in the past. And you can see, for the most part, and by the way, Baltimore is cut off, but Baltimore is the only one where there's actually a reduction in the months of supply. And for those of you in the Northeast, those of you working around DC and Baltimore, you know why. It's difficult to get homes approved there. But you can see we've moved in the wrong direction, because we moved so quickly with adding units, and that's what we ultimately have to burn through. Now, this is the equivalent of what Ali was showing with QMI. These are the units under construction. And notice the little Batman hat that stuck out there for Atlanta. And, you know, we saw something in 2016 and 2017. And I would attribute that to the fact that Atlanta was one of the last markets to the party as the market started to recover from the great financial recession. But as we look at this, you know, this is set up exactly as Ali had showed it. These were the markets that hadn't spiked so much in new construction. But look at the markets on left and right. You know, we separated those the same way Ali had it, but they looked very similarly, very similar. So when you think about this, most of the markets are going to battle the same factor, although the ones on the right-hand side are a little bit more concerning, because notice that axis where it goes to 4.5 months on the right-hand side, left-hand side, 4.0 months. We don't mean to beat a dead horse. We're acknowledging the construction and supply issues that we have. But ultimately, you know, the current factors are what we really want to pay attention to. And that is, how are builders thinking about their land strategy? And if the computer cut off right now and everything went black, the summary is cautious. They're cautiously moving forward. Most builders are pausing on deals in the outskirts, but when it comes to the core of the markets they're in, they're paying attention. But as you talk up to them about the way the market is, there's still a concern that land prices are way too sticky. They're still related too much to the early part of 2022. And for the most part, there needs to be a restructuring of deals. And I think most of the builders that you would talk to would agree with that. Landowners, of course, you know, they love their babies. Every baby and every lot is beautiful, and they've invested a huge amount. We'll have to find where the meeting of the minds will be for this. So real-time housing stats, this really comes around from the summary of what the builders are telling us. And you heard Ali say this, and we'll say it over and over again, just the regional differences are still very, very, very diverse. What is going on in Charlotte is very different than what's happening in San Diego, and certainly different from Dallas. And our publics and privates are coming at the market in different ways. You know, the publics have a little bit more flexibility with pricing. Privates are working hard on bringing in good opportunities to try to keep their backlog there, and also mortgage opportunities that keep people in place. And there's a huge amount of focus on the build to rent world, particularly the single family rental side. And we're spending a huge amount of time working with a number of capital sources and home builders who are looking at that as I wouldn't call it a parachute, but certainly an outflow for keeping a larger amount of homes being sold. And you heard what Ali was talking about with price appreciation. You know, look back at August 21st, August 2021, and even January 2022, you can see that builders were talking about price increases in most markets. Now we've got almost 40% of the market saying we've lowered prices, and another, well, almost the remaining part of the market saying we haven't increased prices. I think you'll find not every location will have price declines, but certainly the markets are looking at it. And as we look at the differences geographically, Truly the Southwest and West, where we saw so much growth, they've had the highest adjustment in pricing. And then the Southeast has been generally stable, and the Northeast is the lowest, simply because it's so hard to find land and get it entitled. Now, if you lowered base prices, did you see a resulting uptick in sales? And we're asking that question constantly because we want to see if there's price elasticity. And I think the key takeaway, whether a builder has made a small cut or a large cut, is simply this. The smaller cuts really didn't get the consumer's attention, $1,000, $2,000. If anything, it opened the door for the falling knife, whereas a 7%, a 10% cut automatically gets attention from the consumer. And I think we found that in almost every single market where we're watching price declines. And many of the builders are sitting on the sidelines, and there's parents telling their Gen X and Gen Y children, just hold on, because right now it's a buyer's market. And I think that for the most part, even though 97% of our respondents are saying it's either a buyer's market or it's getting that way, we can say pretty unequivocally, it's a buyer's market. And look at the left-hand side, the three segments of left-hand side. What are the challenges? What's the operation up against? Hesitancy and affordability. And the buyers aren't getting qualified because of that HPA that happened, and certainly interest rates that have gone up. Now, the cancellation rates, we have insights into these because in so many markets we're tracking these. And you can see the direction that cancellation rates have moved. But there's also another thing to think about. They're different by geography. Once again, we point out that element that all markets aren't created equal. And you can see with the Southwest and West, that's where the largest amount of adjustments have been made for pricing, and that's where the cancellation rates have been the highest. Those two things are inextricably intertwined. And then once there's a cancellation, what happens? And who is canceling? Well, we can see the entry level and move up buyers have been the largest percentage, and luxury buyers and investors, not so much. And don't forget, one of the reasons is that they pay cash. And if you're paying cash, you're pretty much interest rate insensitive, and you're probably going to negotiate price point. And don't forget, there's a whole series of elements. Once the cancellations happen, can we easily resell the home? Well, right now, only 7% of our builders are saying yes. 40% say, well, yeah, we think so, but 53% are saying it's hard. If you go back just to June, 22% said it was pretty easy to do, and 49% said for the most part. So where it's 47% here that can easily or possibly resell, it was twice that just a few months ago. And that's where the price cuts come in. Now let's talk a little bit about affordability and the BTR market, because this is a pretty impactful consideration. When you look at what's happened to the national average price of a new home and unit sizes, look what's happened with the price point. It's gone from about 500 to about 700,000. And over that period of time, homes have gotten smaller. So what does that imply? Look what's happened to the price per square foot over time. That's a 50% increase in a 7-year time frame. Because again, we're looking at price divided by unit size. Higher prices, lower unit sizes. Boy, that price per square foot has moved up pretty quickly. So that is another indicator of the challenge we have for affordability. Now, one of the battles that a consumer can make is let's bring in an ARM. And you can see what's happened. There's been an increase in ARMs over this last couple of months. And right now it's about 12% of mortgages that are being put out are ARMs. And while that might seem a little alarming, since it's up from about 4 or 5% just a year ago, here's some perspective. Look back at 2004 and 5. I mean, we had 37% of our market that was an ARM prior to the Great Recession. So from a perspective of history, we're not in bad shape. But note, this has been an outlet for buyers that are very serious about getting in the market. And once again, we've shared this with you before. This is the annual millennial survey that Allie puts out to thousands of millennials. Just look at the first 5 points. Why do you rent? It has everything to do with affordability. No surprise there. And the flip side is, if we can address that, we've got buyers that are willing and able to buy down the road. Now, most of our builders are paying attention to build to rent, but keep this clear. Build to rent encompasses a wide variety of product, which I'll show you some examples in a second, or at least a list of them. But think of the single family rental as an outflow for the home builders, and then the horizontal apartments as a different product that really falls into the multifamily product. But for the most part, almost half of our builders and friends in the industry are thinking about this, and the other half will be soon. Now, what should you consider as you're thinking about this? And there's a whole series of factors that have to do with how you should get into the space, if you get into the space. Primarily, number one, be intentional. Whether it's single family detached, and a great opportunity is to look at American Homes for Rent and what they're starting to do with their new communities. Mark Wolf at AHV, intentional single family rental communities, beautiful setup. Now, new matters and the consumer, what they want and will pay for is so important. But there's a sixth factor that we didn't put on here that's the secret sauce, and that's property management. You've got to make sure and keep the product in great shape. And ultimately, if you can build it and live in it, it can be rented. And we're seeing this across the board, across the country, a wide variety of product that heretofore might have been rental by default is now rental on purpose. Fascinating to see this shift. All right, we'll bring you to the final thoughts. And, Allie and I and our team, we are constantly researching the world and trying to find out what's happening to the consumer and things that are shifting and maybe, ultimately good news. And here's the first one. If you're an Armageddon fan, if you remember that movie with Bruce Willis, and the concept of an asteroid coming to destroy the Earth, well, NASA just showed that they can actually send a fast-moving spacecraft to change the trajectory of a asteroid coming towards Earth. So I'm feeling better about my future, and I wanted to share that with you guys. Now, how about this one? Plastics in the ocean have been a massive concern, but the government of Indonesia is paying fishermen to fish for plastic. I thought this was a fantastic opportunity to basically use people that understand the water and help clean it. And then for those of you who are boomers or Generation X or millennials, prepare thyself, because we now have our first Gen Z member of Congress, and that's Maxwell Alejandro Forrest. He's 25 years old, and he is in Florida's 10th district. And this is going to be fascinating. For those of you who are thinking about the next level of home buyers, start to pay attention to the language that Gen Z is using about the economy, the environment, where they live. These will be drivers for us in our next generation of housing. A couple more for you before we go. Taiwan Semiconductor Manufacturing Company, they're bringing another $12 billion plant to Phoenix. And oh, by the way, about $4 billion has just been invested in them by Berkshire Hathaway. And so I bring this up just because Phoenix has been so maligned as one of the housing markets that's really taken a hit, but they continue to build a really impressive base of technology, and this is a massive setup for them. If you're familiar with the old movie that I think was a Michael Douglas movie, War of the Roses, well, we have a current War of the Roses going on with Mackenzie Scott and her ex-husband. Mackenzie Scott, of course, was married to Jeff Bezos, and she just gave $85 million to Girl Scouts, and she plans on giving away a huge amount more. Not to be outdone, her ex-husband has finally said, I will be part of the giving pledge, and I will find a way by the time I die to give away $124 billion of my net worth. Now, if a couple's going to fight and end up with this as the outflow, I guess we can live with that. So last but certainly not least, ladies and gentlemen, inspiration. And unfortunately, as time goes by, some of the people and some of the inspiration element has to do with people that are in our industry and built beautiful things, but ultimately people that we've lost. And back in October, Bob Toll passed away. And I want to acknowledge the fact that, he was something else in the industry. I had a chance to meet him a number of times and worked with his organization. And it's such an incredible story with Bob and Bruce and how they started their organization, basically with 2 lots that they got from their father in 1967. They built the homes, they made them their model homes, and from there, over time, built 150,000 units. Also, I want to just acknowledge how many people I respect and have worked with that Bob influenced, mentored, the great operators out there, and people who still work with them. And I send love to Dottie and Ben and Fred and David and Jimmy and Carl and so many other people that work in this organization. And from us at Zonda, and for me personally, I send love to the Toll family and acknowledge what an incredible impact Bob had on our economy and on housing. With that, ladies and gentlemen, Allie and I wrap it up. We want to thank you. You can subscribe to our emails by hitting the UR code that you see here. Also note that we will be sending out the survey. Please give us feedback on the survey. We've got questions today. Allie and I will review those, but everything you have, please share with us. We'll see you next time in January. Thank you, everybody. Stay safe, and we appreciate you taking the ride with us. Take care, everyone. Bye-bye.